Futures rally hard, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katy Greifeld. Sonali Basak is off today, but Bloomberg Open Interest starts right now.
Coming up, stocks soar, yields jump across the board after higher than expected retail sales point to a resilient consumer. On the earnings front, Walmart raises its sales guidance as it expects to draw shoppers hunting for bargains. And following the big money, the latest flurry of 13F filings show top investors reshuffling their positions in the AI boom. Let's start with a look at where markets are trading right now. We see gains across the board in terms of futures and yields. So you can see S&P futures right now up 1%, NASDAQ 100 futures up even more, and the two-year yield climbing 13 basis points, back up over 4% and approaching 4.1. Katie?
Yeah, a lot of action in the bond market at the index level on stocks as well. But let's go under the hood right now because Walmart raised its full-year outlook as it sees growth in general merchandise sales and consumers hunting for deals. Walmart obviously benefiting from that trade down. You also have Deere adjusting its business to weaker market conditions for farmers, but it maintained its profit outlook, and you can see that pre-market Deere shares up about 2%. And finally, we want to talk about Ulta here because the shares on a tear after Warren Buffett's Berkshire Hathaway disclosed a new stake in the beauty company. That stock up double digits pre-market, Matt, currently up about 13%.
Yeah, very interesting stuff coming out of the 13S. We're going to get through all of those holdings a little bit later. Bill Ackman also buying 3 million shares of Nike. But first, I want to get to the economic data coming out this morning. There's a lot of it after the blowout retail sales numbers. Here to break down what we see on the EcoGo screen is Mike McKee, Bloomberg's Chief International Economics and Policy Correspondent. So I guess initial jobless claims is the one that people watch the most closely.
Although I think retail sales will get a lot of attention today because it came in stronger than anticipated, and it does suggest that while the economy might be cooling, it is not falling off a cliff, definitely not falling off a cliff. Now, initial jobless claims did, as Matt said, come in at 227, down from 234. Now, the thing to note there is that the biggest drops were in Texas and Michigan, so it was the hurricane, it was the plant retooling in July, they were seasonal effects, and we're kind of past that now. Companies are not letting people go. Retail sales up 1%, stronger than anticipated. There's a reason for that I'll get to in just a second. Retail sales control, though, that's the one that we take out gas, autos, and building material supply stores, and you get a 0.3 gain. That's up from a 0.1 gain last month. Philadelphia Fed, though, drops off down 7. We also have, I don't have it on the screen, but the Empire Index from the New York area also declined, and both of those showed a drop in hours worked, which is what you would expect if the economy is slowing, but it does show that companies are cutting back a little but not letting people go yet. Import prices, the last thing here to mention, up just 0.1%, no change on a year-over-year basis. So we're not importing any inflation at the moment. Now let's take a look at the difference between retail sales and the control number. The retail sales numbers up by, as we mentioned, 1%, and control a lot less. But look at the GDP Now numbers from the Atlanta Fed up above. They're projecting 2.9%. That's probably going to go down, but the retail sales numbers give you some hope that it's not going to go down all that much. In the third quarter, it's not all that bad. Gets the recession talk out of the markets, perhaps. Now, why did retail sales go up so much? Cars. Matt, it's you that did it this time. We had the internet hack of the retail car sales system in June, and you can see there's a lot of numbers there, a lot of categories there, but it's the blue that matters. When you look on the right-hand side there, you see the big decline in car sales in the month of June, big rebound in the month of July as all those cars that didn't get sold. So look for those to even out, and we'll take that out. So look beyond the 1% headline number. And finally, with jobless claims, I would just invite you to take a look at the chart that goes back to the point where we were the pandemic, and you look at the recessions in the past and you look at where we are now with jobless claims on the lower right-hand corner, you're not seeing any hope for a a problem with jobless claims. And I'll give you one last stat, because I know Katie loves the economic nerd stuff.
I sure do.
In the import prices number, the international airfares to the U.S. dropped almost 5%, which pushes the PCE index down. So a hint that we're going to have an even lower inflation number once we get the PCE inflation data at the end of the month.
All right, it really never ends. We just had that CPI data, but a lot to look forward to there. Bloomberg's Mike McKee, always great to see you, of course. Let's broaden out this conversation now and bring it to the markets. We're going to do that with AlphaSimplex Chief Research Strategist Katy Kaminski. Great name, first off, but let's talk about the reaction that we're seeing in markets right now, because, of course, we had PPI, we had CPI earlier this week, both under control. Then we have strong retail sales. Clearly, consumers are still spending. Futures flying right now. Is this nirvana? Is this what a soft landing looks like in the market?
Well, I'd have to say what's exciting about today is people were nervous that if we had a bad print, that would spook the markets. And so coming in and seeing a positive print in retail sales suggests that the consumer is actually pretty resilient. And it's a sign that maybe some of the things that we endured last week and some of the volatility is still not that clear of a narrative. So we've seen a massive shift from focus on inflation to focus on the economy. And I think that's where sort of every data point seems to matter to the market.
Does the economy look like it's slowing down so much that we need rate cuts here, Katie?
I would say that there's enough evidence that we're going to see a cut, but I think that people got a little bit too excited saying 100 basis points, 50 basis points. I think the Fed is going to analyze all this data and really sort of determine, given that inflation has come down, perhaps it might be time to consider a shift in policy, but I don't expect them to have a big jump. And that's why today you look at Treasury yields today suggest the economy is not that bad. So, Treasury yields have come back over 4%, which suggests that, the market is reevaluating those hikes and how much cuts and how much cuts we might have. Sorry, flipped it around.
Yeah, it would be interesting to see what markets would do if we were suddenly talking about hikes. But I actually want to talk a little bit more about bonds, even though we're, 23 minutes away from the U.S. market open, because you saw something interesting happen last week. It felt like bonds were finally acting as a hedge these last couple of weeks. You saw that inverse correlation between equities and fixed income come back into play. And suddenly, once again, you had bonds acting in their traditional role. But is that sustainable? Do you think that we're truly entering back into that traditional dynamic, or was that a head fake?
So in general, I would suggest that you have to think about inflation. Bonds behave very differently when you have to worry about inflation, and they cease being as much of a sort of equity hedge. And now that inflation has abated, we've seen more and more of the classic risk-off relationship between stocks and bonds. And I do think as long as you keep seeing moderation in inflation, and we're seeing that as well in the commodity sector, suggesting that that will continue, that we're going to perhaps go back to more classic relationship between bonds and stocks as inflation is no longer affecting bond markets as much.
So what kind of stocks do you like here, Katie? Because, we saw a rotation for a few weeks in July, and that was completely erased very quickly. Are you broadening out, at least in terms of, large cap stocks?
Well, this is a good question, because what we have really seen in stocks has been a general parallel decrease in overall conviction in stocks, given the recent volatility. I think we're much more focused on global differences. And what you're seeing now is that the U.S. is still looking pretty strong, while sort of Asia and other places are actually looking a little weaker. So I think the play right now is going to be tricky in individual names, just given the adjustments and the devaluation and then revaluation, but really looking across borders and sort of differences in monetary policy, and might give interesting international exposures at this point, perhaps more interesting to follow.
We keep getting that sort of bait, and it always ends up being a head fake, at least in terms of, buying in Europe. Is this time for real?
Well, I'd say the signals are still even weaker in Europe than we're seeing in the U.S. So I think it's going to take time to see how some of the political situation and some of the different issues going on there can resolve themselves. So I think that's why I was suggesting a more international positioning, looking at US still looks better than Europe and even better than when you look in Asia, where there's been more weaker demand, for example.
And Katy, let's talk a little bit more directly about the U.S. and specifically earnings season, because it feels like this earnings season in particular has been pretty mediocre. You know, we have some big wins. We have a lot of big losses, too, as well. And you think about that earnings picture, you overlay it with what's going on in the economy. Even if we enter into this real Goldilocks soft landing sort of scenario and we stay there, if we have a mixed bag of earnings on the corporate side, can we continue higher on the benchmark level?
I think this is an important point, because when you look at where we've been this summer, we have seen a massive shift in sentiment from the markets focusing on inflation and the Fed to now the markets focusing on the strength of the economy and the resilience for companies to get through sort of how do we deal with cuts. And I think that's why earnings could be something that could trigger as well more concern. If we do see weaker earnings, it would be, again, another suggestion that things may be overvalued. And I think that's why we're going to have to watch them closely and see if Q3 turns out better than what we've seen recently.
Well, from one Katy to another, great to get your thoughts this morning. Really appreciate you taking the time. That, of course, is AlphaSimplex Chief Research Strategist Katy Kaminski. And let's get a check on these futures right now, because they are flying. The S&P 500 currently up about 0.8%, pre-market. Same thing, too, if you take a look at the NASDAQ 100, up even more so, over 1%. And small caps in the lead, up about 2%, I would say. Let's get a look under the hood with Abigail Doolittle.
Well, one stock that's certainly helping out the futures, Katy, let's take a look at the shares of Nike. They're up more than 5% at this point. This after Bill Ackman's Pershing Square has revealed a new stake. They now have 3 million shares worth roughly $229 million. Apparently, they're planning on taking a quieter approach to help the company fix some of its issues. Of course, tough competition from Adidas and Hoka. The stock itself into today down nearly 30% year to date. Turning to the tech space, we do have the shares of Cisco trading higher. They put up encouraging results. They beat. They also offered a solid current quarter forecast. This even as they cut jobs. They're saying that the job cuts aren't to save costs, but more for repositioning toward cybersecurity and the cloud. I would also argue that in the current environment that this could be a positive tell on the IT spend environment. As for Dell, up 3.2%. JP Morgan has added the shares to its analyst focus list. They've hiked the price target to $160, saying that the recent earnings reaction is overdone, that this company has long-term robust positives. And then finally, one laggard here in the morning, or at least one that we're taking a look at. Snowflake shares are down 3.5%. This after Berkshire Hathaway exited their position. We also have Wells Fargo cutting shares to an equal weight from an overweight. The analyst there, Matt, saying that the company is facing decent headwinds. In addition, the valuation at this point hard to defend.
All right, Abby, thanks very much. Abigail Doolittle there talking to us about some of the individual names. We are still about 17 minutes to go until the start of the cash trade. Coming up, bargain hunting shoppers are boosting the shares of Walmart. You can see in the pre-market up 9%. Walmart raising its full year guidance on sales and profits. More on the results next. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. The president of Columbia University resigned after months of chaos on campus sparked by protests over the war in Gaza. Minu Shafiq's ouster is the third time the leader of an Ivy League college has left because of campus demonstrations opposing the U.S.'s support of Israel. And the fall quarter starts soon. Around $861 billion is what it costs the U.S. government to service its debt in net interest payments, nearly doubling what it was 2 years ago. But it's not even counting $100 billion in a bill from the Federal Reserve. That figure is more than the government's annual spending on NASA, the Federal Emergency Management Agency, FEMA, and the Small Business Administration combined, which means the U.S. is spending almost $1 trillion already over a 12-month period on servicing its debt alone. Starbucks, meanwhile, bet on Brian Nickel. It will cost the coffee chain at least $120 million. The former Chipotle boss is set to be one of the highest paid CEOs in America thanks to this pay package. It's worth $113 million in total because Starbucks is offering him equity to replace awards that he's giving up as he leaves Chipotle. Katie?
All right, we do have some breaking eco news right now to follow on what we learned at 8:30. We just got U.S. July industrial production numbers, and they fell 0.6% month over month. That is a little bit more than the estimate, which had been calling for a 0.3% decline. But you take a look at futures right now, not necessarily making a dent. Meanwhile, let's turn back to earnings because one stock, of course, we're keeping an eye on is Walmart. The company raising its full year outlook as shoppers continue to search for bargains. And joining us now for more, I'm pleased to say we have Cristina Morales. She is senior analyst over at Signum Research. She has a buy rating on Walmart with a $72 price target. And it feels like Walmart pretty much does well in any economic environment. But in this one in particular, it seems like Walmart really benefiting from that trade down.
Yeah, it's true. It's a very defensive stock. And in this environment, it's true because people and consumers are searching for more value items, for more value for their purchases. And Walmart is there. It's offering all kinds of products with in a very wide range to consumers. This quarter, they said they gained again market share, and especially they're luring these higher income consumers. So their broad base of consumption is increasing, and it's quite beneficial because not only the sales are increasing, same-store sales, but also the margins are increasing. The profitability, it's growing. So it's not that the people or the consumers are trading down, and that's why they're going to Walmart, but they're looking for more value-added products, and that's why it's driving the consumption in these stores.
Cristina, I saw that general merchandise, which includes everything from clothing to, household appliances. In this segment, I was shocked to see that Walmart has had 11 consecutive quarters of declines. Now they're finally gaining back in that segment. What does that turnaround mean to you?
It's quite good. It seems that not only the consumption is hanging in there, but also the company is doing everything they need to attract the consumers. They're making every time more wide the variety of consumption they're doing. The sales via e-commerce are doing quite well. They had a 22% increase in e-commerce sales. They said they wanted to be a very good competitor to Amazon, and they're achieving that. The sellers are increasing. The marketplace is doing quite well. And I think that it's the thing that is supporting this increase in general merchandise, that people are finding the items they need in e-commerce and in store-based.
Cristina, thanks so much for joining us. Cristina Morales there of Signum Research. Talking of general merchandise, Katie, one of those items that they sell is a pool noodle. You know, the styrofoam.
I've heard of them.
And apparently they sold so many pool noodles that if you stretch them end to end, it would cover 30,000 football fields or 1,700 miles, which means you could stretch the pool noodles that Walmart sold from here to Belize.
See, you could be lying right now, and I would just believe you. Because where did you even find that? Is that on the terminal?
I heard that from the CFO. John David Rainey was saying that in the presentation this morning.
Well, I would believe that, man. And the stock, responding. Maybe not to that specifically, but...
All right, let's move on to Cisco. They sell enough stuff to stretch from here to Belize and back. Shares moving higher in the pre-market. The tech giant announcing a bullish revenue forecast for the current quarter thanks to a rebound in orders. Cisco also announcing thousands of job cuts as part of a strategy shift. Jin Ho joins us, Bloomberg Intelligence Senior Analyst for hardware and networking. And Jin, this is odd because it's a bullish outlook, but they're firing thousands of people. How do you square that circle?
Yeah, hey, Matt. So I think there was some concern when the original reports of headcount cuts meant that the demand environment was going to be weak. Quite the contrary. When they made their first round of headcount cuts a couple of quarters ago, I didn't think they did enough, quite frankly. And I think this round actually right-sizes the business Another thing in terms of the headcount cuts, you're not going to get the margin expansion that one had hoped for, or at least I had hoped for. And they're essentially redirecting some of the cost savings back to the growth areas, which is security and software.
Yeah, it's interesting looking at comments from the CFO. He said that the layoffs, it's not about trying to boost profits. It's more freeing up resources to shift into cybersecurity, cloud systems, AI-related products. I mean, reading between the lines there, does it sound like they're going to be hiring in those areas?
Yeah, for the most part, Katie, they are. If anything, look, they made their acquisition of Splunk, which closed last quarter or a couple of quarters ago. And they're doubling down in those growth areas. That Splunk and software business is supposed to be growing at a mid-teens rate. Now, counter to that, the core networking business is growing at around a low single digits rate. So, if I'm going to spend my money, I'm going to spend my money where it's going to grow 15 to 20%.
All right, Jin Ho of Bloomberg Intelligence, really appreciate that breakdown. Cisco shares currently up about 7.4% pre-market. We're going to continue to keep an eye on that one. Now coming up, why Warren Buffett is going big on beauty products. We'll have the details next in today's Social Climbers. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves on social media this morning. And first up, the U.S. fining T-Mobile $60 million for failing to prevent and report data breaches that happened in 2020 and 2021. The Committee on Foreign Investment in the U.S. levied the fine earlier this year. T-Mobile had signed a national security agreement with the government watchdog in 2018 as part of its merger with Sprint. Next up, Gambling.com playing a winning hand today. The online betting marketing firm reporting a robust second quarter result and raising its full year guidance as well. And finally, Ulta Beauty showing off its shine after Warren Buffett's Berkshire Hathaway disclosed that it took a new stake in the cosmetics retailer. It's been anything but rosy for Ulta, though, since March when it gave that disappointing outlook for the year and said that higher supply chain costs and increased promotions hurt its margins. Of course, you can follow all the latest company buzz on TRE & Go on your Bloomberg terminal, Matt.
All right, very interesting stuff. Let's take a look at what's going on in the markets. We are rallying in terms of futures ahead of the open, just 4 minutes away. The S&P 500 up 0.9%. NASDAQ 100 futures gaining more than 1%. And look at that, Katie. Russell 2000 futures up more than 2%. It could be a great day to restart that rotation.
Here we go. Yeah, the rotation trade. It's coming up. And
all eyes on the consumer, I guess, this trading day. We're going to cover the open with PGIM Quantitative Solutions Chief Investment Officer George Patterson. This is Bloomberg. We are moments away from the start of trading. Looking at a rally today, folks. And we're seeing gains of more than 1% across the board. Check out the futures here. S&P futures up 1% and change, basically. NASDAQ futures up 1.25%. Russell 2000 futures up 2.25%. So it could be a really good day for those small and mid-cap stocks. Ringing the opening bell here on the New York Stock Exchange. You've got United Community Banks over here at the NASDAQ. You've got Second Chance Rescue ringing the opening bell. And we are seeing, obviously, the cash trade kick in at a higher level than the close yesterday. In fact, let's take a look at the indexes here. The intraday move about 1% on the S&P, what you would expect. The NASDAQ gaining a little bit more. Actually, it looks exactly like futures lined it up for us. Russell shares trading up 2% in the cash trade. In terms of individual stocks to watch, I'm focused today on John Deere, surprising analysts by reaffirming its profit outlook despite weakening market conditions. The company is adjusting production to meet the downward trend in demand because crop prices have fallen through the floor and farmers can't afford to buy new tractors. Sales dropped 17% in the fiscal third quarter. And nonetheless, we see the shares up 2 and change. Katie, what are you looking at?
Also keeping an eye on Tapestry here. That's, of course, the company behind brands such as Kate Spade and Coach. Quarterly profit topping analyst estimates. Retailers warning of a slowdown in consumer spending. But still, Tapestry raised prices during the pandemic amid high demand, surging inflation paying off. You can see shares currently up about 4.8%. We should also talk about Walmart, though, now at a record high. That's after it raised its sale guidance for the full year, hoping to draw shoppers looking to save on deals. Let's take a closer look now with Bloomberg's Abigail Doolittle.
Yes, Katie, a big gain here for Walmart. The best day, in fact, since March of 2020. So that's the degree of the buying power that we are seeing here for Walmart, up 7.8%. You can see really outperforming the group, but at the same time lifting the group after they did actually miss earnings just slightly. But the sales beat was robust, well, somewhat robust. But we also had same-store sales comp up 4.2% versus the estimate of up 3.4%. Something that really stands out relative to revenue, if we take a look at it on an annual basis, we're going to see some really nice gains here. Now, it's interesting, like sequentially, the quarter that was just reported, growth did drop a little bit, but annually you can see moving in the right direction. And what makes this so interesting is that they are talking about that the higher income consumer, that's really where they're getting this extra boost from, so to speak, that groceries are going gangbusters still. And in addition, e-commerce is strong. They're saying that customers, they're not seeing any signs of their wallets fraying at the edge, but that they are seeing some really discerning, choiceful customers. When you put all this together, Katie, you have to wonder, maybe, whether or not there's something more severe ahead economically. We're nowhere close to a recession right now. But if we were to go there, you can see back in 2020 and then during the GFC that Walmart, relative to the S&P 500, outperforms in a big way. It's interesting to note right now we have a series of higher highs, suggesting that maybe at some point we are going to see Walmart do that again. And again, as we do have these signs that the higher income consumer really choosing Walmart, going there and being very careful with their purchases.
So much. And I'm pleased to say that we're joined now by PGIM Quantitative Solutions Chief Investment Officer George Patterson, joining us on set. Great to see you in person.
Great to see you again, too.
So let's talk about the economic environment married to earnings right now, because like Abigail said, really no signs of a recession. But then you think about some of the comments that we're hearing on these earnings call about the consumer trading down, being choiceful. Does that give you any pause about the landscape heading into 2025?
Not really. The consumer is healthy, and we're very much in a good, not quite a Goldilocks, but a very good scenario. So, we do look at a number of large bellwether firms, but there's many other firms, and I think that's one of the advantages of our approach, which is a quantitative approach, because we're able to scour and look across thousands or tens of thousands of companies.
And it's interesting, this is something we were talking about with Katy Kaminski at the top of the hour, that earnings have been kind of mixed, kind of meh. But then you think about the economic environment. You think about the volatility that we saw in the past month when we were really nervous about that growth scare. It really feels like it's the economic environment that investors are queuing off of right now.
Yeah, the economic environment people are trying to read the tea leaves, and this is the big challenge. It's always challenging. I find it a bit odd that you get one data point. Nothing has really changed in the world, but people getting the data point can really cause people to take big positions or put on big trades. But economics moves a little bit slower.
Does it worry you? I mean, you say that you see no indication of a recession, and yet, the yield curve has been inverted for a long time. We got the SOM rule triggered with unemployment jumping to 4.3%. Credit card debt is off the hook and very expensive at these rates. The U.S. is paying, basically $1 trillion a year just to service our interests. Are you not worried about a recession?
So we're definitely worried about a slowdown, but it's a very low probability. I think the deficit and the debt is a big issue, and that's going to be a definite limit in terms of like what flexibility government officials are going to have in terms of future fiscal policy. But in the near term, we really see that things are very strong, not booming, but no signs of an imminent recession. For example, go try and get a restaurant reservation for Friday night. Still pretty hard to do.
Are you worried at all about positioning? We heard so much talk about the carry trade last week, and maybe it's unwound, but who knows if it's still a problem, right? It's so hard to see. And then Bloomberg has a great op-ed piece about private equity and how much leverage they've put on top of leverage on top of leverage.
You sound worried, Matt.
No, I'm just trying to offer some potential, I guess, brown swans here. Do you worry about any of these things?
I don't worry about private equity because largely, if you have to look at who owns the private equity, and the owners of private equity are large institutions, large plans. They have prepared for this. They have managed their liquidity so that they can deal with these cash calls from private equity. So that's the biggest challenge is that when you get into private equity, you can't get out easily, and you have cash calls. So you need to have a liquid portfolio around that. It allows you to be able to fund those calls without selling the asset that you want to own for the long term.
Let's go around the world here. I want to go to small caps because we launched this show on July 8th, and then suddenly small caps were ripping. It was very exciting. We were talking about this broadening out. Then it fizzled. Now you have the Russell 2000 up 2%. What is going on with small caps? What is the mood music there?
So people are expecting rate cuts. And if you look, where am I going to benefit the most from a rate cut? It's in small cap. Those are the companies that are more susceptible to needing financing. They probably don't have fixed rate financing. Much more of it's floating. A little bit less quality than in large cap. They don't have the same terms that like a Walmart or a Home Depot can have. So if you look for the marginal trade, it's in small caps. And if you go back to July 12th, 13th, it was really industrials, financials. A little bit of consumer that really took off. REITs also will be a big beneficiary. So again, I think small caps are going to move, right? There's a huge valuation gap. Small caps are going to move based on potential interest rate cuts, but again, there's a huge move out there. This one was a little bit of a head fake back in July.
What kind of interest rate cuts do you expect? I saw, by the way, Raphael Bostic. It's almost like somebody at the Fed called him up. Tuesday, he was out saying, like, we don't need to cut rates. I don't want to do it till the end of the year because I need to see more data. Then I'm sure someone calls him in the middle of the night. And then on Wednesday at the FT, he's like, actually, I think September is a good place to start.
Yeah, in all honesty, it's a tough, it's a very tough thing. So what I will remind you is on the whole way up that people were talking about increasing rates, the forecasts were all wrong, right? They kept raising and raising and the forecast caught up. So again, I think to be honest, it's more important to think about your long-term investment strategy than try and forecast, are we getting 25 or 50? A lot of times it's, for us, for our clients, that's the most important fact is getting the long-term perspective correct.
Well, when you look medium term, when you look long term, what's the conviction trade right now? Or the conviction investment, if you want to call it that?
So if you're looking for conviction, I would say small cap, maybe a little bit of mid cap. Not so, you don't want to go so far down in small cap that you're having negative earnings, but I would say more in the the upper part of small cap or mid cap. And again, anything that's interest rate sensitive.
High quality small cap.
High quality small cap. I don't think now is the time for kind of a junk rally. There will be a time for it, but I think it's a little bit too early.
All right, George, great having you on the program. Thanks so much. Please come back soon. George Patterson, PGIM Quantitative Solutions Chief Investment Officer. Coming up, we're going to talk about John Deere, reporting more than a 40% drop in year-over-year net income. I told you about the 17% drop in sales, but the company reaffirmed its outlook in a surprise to analysts, and as a result, the shares in the cash trade are now at more than 5%. We'll talk about that next. This is Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, KeyBank says Brinker International is a buy. The analyst sees a compelling entry point for the stock following its post-earnings decline. The parent company of Chili's and Maggiano's Little Italy issued a fiscal year profit forecast that trailed estimates yesterday. But the KeyBank analyst says that the results were misunderstood. Next up, Deutsche Bank says that Robinhood is a buy. The analyst says upside for the e-broker looks good in both the near and the long term. Robinhood, of course, reported strong second quarter earning results last week. And finally, it's the Goldilocks scenario for chicken. Well, it's over, according to Bank of America. The firm says that Pilgrim's Pride, it's one of the largest poultry producers in the U.S., no longer a buy. Bank of America says share upside will be more difficult given the downward pricing pressure on chicken.
All right, I'm glad I know that. Thank you very much. Taking a look now at Walmart. It hit an all-time high this morning on its way to its biggest single market cap ad in the company's history. Take a look at this fantastic chart that Terrell Holt put together. By the way, you can make that panel disappear. Good job. All right, this is showing that Walmart today is adding almost 40 billion, or exactly $40 billion in market cap after raising its forecast for revenue and profit for the full year. So pretty amazing stuff. Let's turn to another economic bellwether that's in a world of hurt in comparison. John Deere shares, they're actually rising because the company reaffirmed its profit guidance, but analysts expected Deere to cut its outlook due to weak market conditions. Soy and corn prices, as we talk about this show, are at the lowest levels since 2020, giving farmers little reason to splurge on new equipment. Bloomberg Intelligence industrials analyst Chris Ciolino joins us right now to talk about it. And Chris, it's amazing that they didn't cut because, you know, the profit fell 40% in the reporting period, sales fell 17%, and we know that farmers are earning considerably less money than in years past. Like, I think net income for farmers fell 26% last year because we have these crop prices falling through the floor. So why is Deere holding tight?
You're right. I mean, these results were a lot better, or not as bad as many had feared heading into the print. The top line, margins, earnings, all better than expected in what is, as you mentioned, a pretty challenging environment for farmers. Pricing, I think, was a real standout in the quarter, continues to be remarkably resilient. We saw pricing actually uptick here in the ag businesses in the quarter. And to your point, they largely kept their 2024 outlook intact when all their peers cut their outlook this quarter. So while we don't think we're out of the woods yet, and there's certainly probably more downside in 4Q as they continue to cut production and manage the inventories, I think this probably alleviates some concerns of a more severe downturn in the near term.
Well, even still, I mean, you talk about their peers cutting their outlooks and what seems to be an industry-wide issue. Of course, Deere apparently resilient here. But with that, all of that in mind, I mean, are we potentially setting ourselves up for disappointment in 3 more months?
I don't think so. I think it's pretty well understood that 4Q is going to be weaker than 3Q. The question now, I think the biggest focus will be on, can they get inventories in line with production exiting the year so that they could produce in line with retail demand in 2025. Inventories are still quite elevated. They were relatively flat in the quarter, but there's still a lot more that needs to be done to bring those down as we look towards 2025.
In terms of the crop prices, is there anything to support a rebound here? I mean, I know it's record production. That's one of the main reasons for the drop. What's the outlook?
Yeah, if you look at crop prices, and really the ones that matter for Deere are corn, soy, wheat, we're down 15-25% plus here year to date. The crop price outlook, isn't particularly encouraging given the record production that we'll see. Obviously, weather could always throw a wrinkle in things and is a wild card. But at least for the near term, there doesn't seem to be any kind of immediate support on the crop price front, which obviously pressures farmer income and their appetite to go out and spend on equipment.
Well, at least in the near term, Deere shares certainly higher right now, up to the tune of about 4%. Bloomberg Intelligence industrials analyst Christopher Ciolino, really appreciate your insight there. Now, coming up, hedge funds still leaning on big tech, and Bill Ackman's Pershing Square running over to Nike. That and more in our Wall Street beat up next. This is Bloomberg. This is Bloomberg Open Interest. Let's take a check on markets right now. About 20 minutes into the cash trade, we are absolutely flying right now. The S&P 500 up about 1%. You take a look at the NASDAQ 100 up 1.5%. We got good news on retail sales today. The consumer still spending, and investors clearly like that. Bond investors, not as much. A sell-off underway. You have 2-year yields currently up about 14 basis points, Matt.
All right, getting ever closer to 4.1 on the 2-year. Time now for Wall Street Beat. Hedge funds are still buying into tech names like Apple for the most part, but they're trimming positions in some. including NVIDIA, as they reshuffle their portfolios. For more takeaways from the 13F filings, we're joined by Bloomberg hedge fund reporter Hema Parmar. Hema, thanks so much for joining us. Let's talk, first of all, about what we're seeing and what the most interesting moves are. I thought the NVIDIA someone trimmed a stake by like 84% in NVIDIA. I thought it was pretty interesting.
Yeah, we are seeing some selling of NVIDIA, and it's really prescient if you did cut that stake ahead of the volatility that we saw, and that's one thing we're really looking at is how funds were positioned ahead of the volatility. So some selling of NVIDIA, some selling of Microsoft to buy 140 funds, some selling of Meta too. On the flip side, some buying of Amazon, Taiwan Semiconductor, aggregate buying of Apple. They saw the most buying in 3 months in that stock across a number of funds.
It was Tepper, by the way. I just looked back at my notes. So Appaloosa cut its stake in NVIDIA by 84%. It's now 1.4% of the portfolio.
Yes.
Cut its stake in Alibaba by 7%, but Alibaba is still 12% of all of Appaloosa's holdings.
Very big position.
And Chinese stocks are like 26% of all of their holdings. So
he's very focused. He's a very concentrated portfolio. On the flip side, though, Michael Burry increases exposure in Alibaba. So it's interesting when you see these concentrated investors taking opposing positions and having opposing views.
And of course, these are a backward look, but it'll be interesting to see. Of course, NVIDIA doesn't report until the end of this month. It feels like the stakes really high.
Right, but the Chinese economy hasn't looked like healthy previously, right? It's looked bad in the last quarter and the quarter before and the quarter before.
Yeah, well, David Tepper's sticking by that bet. Let's talk about Berkshire Hathaway, though. Ulta Beauty, obviously, really moving on the heels of that news. I mean, what do we know there?
Yeah, so he's starting a new position in Ulta, driven the stocks up a little bit. It looks like he might be buying the dip. That stock's fallen a great deal over this year, picked up a little bit since. He's also started a new position in an aerospace company called Heiko, and he was on a selling spree earlier this year, cutting his Apple stake by about 50%. So we're seeing, some potentially bearish sentiment, but clearly a bullish view on Ulta.
Do people still watch? Is Berkshire still the most important 13F that you get?
It's up there. People really love to know what Warren Buffett's doing. Them, maybe the Tiger Cubs. I would say anyone that has a directional view. We don't really look so much at the multi-strats or the quant funds because they trade in and out of stocks so frequently that a snapshot of one specific quarter may not tell us that much.
Yeah, well, that's what I wanted to ask. Of course, this is a backward-looking snapshot. You also track hedge funds' returns very closely.
Yes.
How closely do the 13Fs that we get versus the returns, how linked are they?
Because it's a little bit backwards looking, it's always a bit delayed. So right now, we really do care about how funds are either looking forward or how they manage the volatility. And the 13Fs, while insightful, they really only show us through June. So there's always a bit of a gap. Typically, we hear performance numbers as of now, and the positioning is a little bit dated. So it's not always helpful in that respect, but it does give us some clarity into tech positioning, into how funds are maybe taking bearish or bullish views on their equity exposure. So it tells us some things for sure.
All right, Hema, thanks so much. Hema Parmar reports on hedge funds for us, talking us through the 13Fs. I noticed the Silver Fox made a move in Nike as well.
Did you see that? About Bill Ackman?
Who else would I be talking about?
I don't know. There's plenty of people on Wall Street with silver hair, but that was interesting. Talk about buying the dip there. Of course, Bill Ackman moving into Nike. He has a pretty small portfolio overall, so it's always
in terms of the number of stocks that he holds.
Exactly.
Yeah.
Exactly.
But 3 million shares in Nike at $230 million stake in Nike. So it's pretty interesting move indeed. All right, let's get you to the trading diary. What you need to be watching this afternoon and tomorrow. We're going to hear from Philadelphia Fed President or Fed head Patrick Harker this afternoon, and the Fed talk has been coming fast and furious. It's hard to keep up. Tomorrow, U.S. housing starts are released. Plus, University of Michigan consumer sentiment data comes out. And we hear from Chicago Fed President Austin Goolsbee, who is concerned about the labor picture in the afternoon. Coming up in the next hour, we're going to hear from the chief economist at Mastercard. Michelle Meyer joins us. Also, the CEO of Priceline. That'll be fascinating as we get a look at what the consumer is doing in terms of travel. Have they been pulling back? And we're going to go out to Carmel, California, where Dave Majors is standing by, the CEO of Mecum Auctions. They kick off a 3-day sale at Monterey Car Week ahead of the Pebble Beach Concours d'Elegance. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katy Greifeld. Sonali Basak is off today, but coming up this hour, stocks soar and yields jump across the board as higher than expected retail sales point to a resilient consumer. And speaking of that consumer, we'll talk global travel trends with Priceline CEO Brett Keller as vacationers make their Labor Day plans. And on the campaign trail, Donald Trump downplays the economy's significance as Kamala Harris proposes a price gouging ban on food and groceries, Matt.
All right, that'll be all interesting stuff to talk about.
Big time.
I'm really looking forward to it. But the markets have to hold your focus right now. The S&P 500 up more than 1%. The NASDAQ 100 up almost 2%, and I think the Russell 2000 is there as well. Meanwhile, yields are rising. We saw the 2-year earlier at 4.09, the 10-year at 3.94. So we're getting 15 basis point moves in bonds today as we get good news on the economic front.
Yeah, and it has certainly been an eco-heavy week from PPI to CPI and retail sales this morning. Let's break it all down now with Mastercard Chief Economist Meyer. Great to have you with us on this week in particular. You take a look at retail sales really blowing past the estimates here. People really outspending in force, but take us below the surface there. What are people actually spending their money on right now?
Well, in this most recent report, the majority of the categories of retail spend increased. So it showed some breadth in the spending, even in the face of some, kind of pops higher, like what we saw with autos, for example, because of some of the special factors. So you do see that consumers are out there spending, and that's quite consistent with what we're seeing in our own insights. Our spending pulse data is showing continued growth, really being driven by online spending, particularly this last month with online retail sales ex autos running just above 8% year over year from our spending pulse data. And similarly, we're seeing consumers out there spending, but being mindful, making choices in terms of how they want to deploy their dollars, whether it's still for some summer experiences or now they're looking for some restocking or the replacement cycles kicking in for some electronics as well.
Interesting. And so we think about that mindful, that choicefulness among consumers. I mean, does that speak to this trade down, or are we seeing people actually rotate from more discretionary categories into more heavily spending on staples?
I think it's all a function of the fact that we're still coming out of this very unusual economic cycle, and we're trying to find a new balance and a new normal. So the cycles for the consumer basket were not uniform, right? When we first came out of the pandemic, we saw everybody buying these big durable goods, household appliances, electronics, things that they needed to stay at home. Once you had that reopening, once travel was back, it swung dramatically the other direction, especially in an environment where interest rates were higher, making it less attractive to buy those interest rate sensitive items. And now I think we're past some of those really large swings and we're finding a new equilibrium. And that means for some categories, consumers are going to be a lot less willing to accept higher prices. We're going to see disinflation, or even for some big ticket items, deflation, which was also revealed in the CPI report earlier in the week.
I mean, you mentioned retail sales already, Michelle, and good morning, by the way. A huge bounce back. I look at the Bloomberg has this ECAN function where we can really look at a granular level at retail sales, and it's impressive to see the auto sales bounce back after the auto sales drop. It's the blue block for those of you looking at the chart here on TV. What's the story with auto sales? I mean, taking away the noise of this month and last month, what does the trajectory look like to you?
Well, Matt, I know autos is near and dear to your heart, so you probably have that perspective better than anyone else. But I mean, I think part of what happens in autos, notwithstanding the most recent month, because that was due to idiosyncratic factors related to the cyber attacks. But in general, autos is an interest-sensitive sector. So an environment where interest rates are rising quickly, affordability gets challenged. And certainly we saw that in terms of some dampening sales as interest rates were heading higher. We're now seeing the reverse, right? Markets are certainly pricing in Fed cuts, and the Fed is signaling that easing is coming. So I think we're going to be entering an environment where it becomes a little bit more affordable for people who have been waiting on the sidelines to make some of these big ticket purchases.
In terms of rates, what do you expect? I mean, we were hearing for a long time 75 basis points, 50 basis points, not a long time, a couple days, basically, after the growth scare of last Friday. That seems to have all died down. And even though Bostic made like a quick turn to the end of from the end of the year to next month, it does seem like people are now in agreement that we only need 25 basis points and we don't need to front load all the cuts this year.
So when we look at it at the Mastercard Economics Institute, we're looking at where we're seeing the economy going in the medium term, right? Because monetary policy, of course, works with, as we all like to say, long and variable lags. And I think that the markets overreacted to what happened after the jobs report, assuming that the Fed was significantly behind the curve and had to catch up. That was not what we were seeing broadly in the data, right? With you look past that 1 month of data, the labor market is cooling. It is not collapsing. Right, we are still seeing record low jobless claims. We're just seeing a moderation in the rate of hiring. We're still seeing the consumer spend. We're just seeing a consumer that's a lot more choosy and really conscious of the prices that they're accepting. We're still seeing investment, but again, a prioritization of the type of corporate investment. So to me, it's an economy that needs a normalization of monetary policy, not a dramatic easing of monetary policy. So I think what the market is now heading towards, which is perhaps a more measured cutting cycle, is the right approach, with increasingly 25 basis points being priced in September seems quite reasonable. Of course, we're going to hear from Fed Chair Powell at Jackson Hole. That's going to be important. We have to look out for the next jobs report. But I think the market has now settled down to the idea that the Fed is going to be easing, going to be normalizing monetary policy.
Right, a lot to look forward to at Jackson Hole. It seems like they always tend to make news out in the mountains there, but I'm glad that you brought up the long and variable lags, because I want to talk about that as it pertains to the consumer level. If we get a 25 basis point cut in September, do we actually see that translate to the credit card spend level? How does that actually affect actual citizens?
Well, you have to think about that interest rate transmission. And it's not just when the Fed starts cutting, it's when the market starts pricing it in, right? So you already are seeing an easing of financial conditions now that the market's pricing in these Fed cuts with interest rates heading lower. And over time, that does feed into the economy in some segments faster than others. So in the face of the big move in markets over the last 2 weeks, there was a pop higher in mortgage refinancings, for example, when you look at what's happening in the mortgage market. So I think the consumer responds. I think in general, borrowers start to see some impact in terms of lower interest rates, but it takes time ultimately for both the increase in interest rates to feed into the economy fully and that decline, particularly in the U.S., where we have a lot of fixed rate mortgages.
Yeah, 80% locked into mortgages under 5%. Michelle, great to have you on our new show. Really glad that you could come on. I hope we get you back soon. Mastercard Chief Economist Michelle Meyer. Let's get a look now at the stocks moving at this hour, just about 40 minutes into the trade. For that, we go to Abigail Doolittle. Abby?
And not surprisingly, with the indexes trading sharply higher, we also have some stocks beneath the surface helping out that action, one of them being Cisco, up 9%. They beat both top and bottom line estimates. They also raised the guide on sales for the current quarter in a very healthy way. The full year guide of $55 billion to $56.2 billion really supports a path for demand stability, at least according to some analysts. They did cut jobs, but folks are viewing this as a positive since they're cutting jobs to then bulk up in newer areas such as cybersecurity and the cloud. And I would also suggest this really points, this strength, especially the sales guide, points to the strength, the stability of the overall IT spend. As for the shares of Ulta, these are also sharply higher, up about 9.7%, as Berkshire Hathaway has revealed a stake. They bought about 690,000 shares. The stake is valued at roughly $266 million. And right now, this stock having its best day going back to December of 2023 at the highs. It had been the best day since 2020. And then finally, rounding it out, another gainer on 13F action. Nike Pershing Square has revealed a new position. They now own a total of 3 million shares worth about $229 million. The sports retailer, Katy, of course, has struggled this year. Competition from Hoka and Adidas. Inventory issues into today down 29%. But folks seem encouraged by Pershing Square's stake and also the promise for a quiet approach in terms of turning things around.
Yeah, definitely some needed good news for Nike there, down by more than 20% year to date before that news. Abigail Doolittle, thank you so much.
Is that your favorite segment, the running shoes segment?
Absolutely, yeah.
Do you wear Nike running shoes?
I am a Hoka gal, but I do wear Nikes for road races. Their super shoes are pretty fun. Very expensive, but,
What about Adidas?
Not as much. And it's interesting that you went with that pronunciation.
Yes, because the founder was named Adi Dassler.
Yeah.
And hence the Germans pronounce it Adidas.
Here in America, though, I think we say Adidas. But in any case, coming up, speaking of America, Kamala Harris will propose a price gouging ban on groceries as it all comes down to the economy for the 2024 presidential election. That's next. This is Bloomberg.
Now to high interest, to look at what's making headlines around the world. A drunken evening and a rented yacht were behind the destruction of Nord Stream 2. This according to reporting from the Wall Street Journal. Officers involved in the plot, Ukrainian officers, point to heavy boozing, patriotism, and iron determination of the people involved, leading to the blowup. Despite initially approving the plot, reportedly, President Zelensky actually asked them to halt it after the CIA told him to pull the plug. It's an amazing story. Americans appear to be yanking money out of their stock brokerages accounts to fund their online betting. That's the key finding in a recent study which reports that the worrying trend is most acute among the most financially strained households. That part is no surprise. Federal authorities have charged 2 men visiting the U.S. from South America with stealing $1 million Patek Philippe wristwatch at a Beverly Hills restaurant. Authorities said the thieves were part of a crime tourism ring. A spate of watch thefts has plagued New York City in recent months, with the latest recorded on August 9th at a subway station. So it's happening, Katy, on both coasts.
Well, let's turn to politics now because Kamala Harris set to propose a federal ban on food and grocery price gouging. Polls, of course, have shown that the economy is the biggest issue for voters this November, and Trump holds a wide lead over Harris when it comes to economic policy. But yesterday, Trump downplayed the economy's role during a speech in North Carolina.
We're talking about a thing called the economy. They say it's the most important subject. I'm not sure it is, but they say it's the most important. Inflation is the most important, but that's part of economy.
Joining us now for more is Bloomberg's politics editor, Laura Davison in Washington. Let's start with Trump. This, of course, was interesting because, as I mentioned, he is holding a lead when it comes to voters' perception of the economy. So a bit of an about face here, it seems.
Yeah, this has been sort of a rough couple weeks for Trump as he's been trying to recalibrate his messaging. The entrance of Harris into the race has sort of thrown him off course. So he's been doing, his campaign staff at least has been trying to keep him more on message. So this speech he did yesterday in North Carolina was billed as an economic-focused speech. And he did talk a lot about the economy, gave out some vague proposals, some of the things he's talked about in terms of not taxing tips, not taxing Social Security, wanting to increase tariffs, wanting to, get rid of any, efforts to move towards electric vehicles. But he a couple different times referenced, I don't think economy is the most important issue, kind of vague statements of they wanted me to give an economy speech. Clearly that he's, not totally on board with focusing on economic messaging, despite the fact that, as you point out, that he actually has a wide lead over Harris on this. Voters trust him a lot more. And when you talk to voters, and particularly high dollar donors, why they want Trump, they're, frequently reference things like tax cuts and his sort of, tough on China stance.
It is no surprise that Donald Trump is not sticking to his talking points, but it does look like Kamala Harris is kind of ripping them off, right? I mean, she has stolen some of his policy. For example, the no taxes on tips, and she's all over food inflation, right? She wants to ban price gouging. I'm not sure how that would work, and it is already illegal in most states anyway, but what are we learning about her platform?
So she's bit by bit sort of rolling out some of these things. And these are key issues that when you look at sort of what is behind the proposals, these are things that appeal to key voting blocs. So the no taxes on tips, it's no surprise that both Trump and Harris proposed this idea in Las Vegas, where there's a high proportion of voters who are tipped workers, people who work in the hospitality casino industry. Also, things like price gouging, those are and groceries. Those are things that appeal specifically to women, specifically to suburban women. And in sort of these blue wall states, Michigan, Pennsylvania, Wisconsin, that's where the economy is doing most poorly of all the swing states and where people are most feeling the pinch on household budgets. So it's a key sort of way to go after voters, even if these proposals, aren't likely to ever come to fruition.
And it's interesting, too, in addition, that your team's reporting shows that she also plans to carefully scrutinize mergers. You think about the Kroger-Albertsons tie-up, for example, potentially in the balance here. I mean, what do we know about that?
Yeah, so this is a continuation, and this is kind of her showing her cards of how she would proceed on antitrust going forward. The Biden administration has taken a pretty strident stance there. Lena Khan at the FTC has been at the forefront of that, and she's showing that she would not back down at all. What's interesting as well is that J.D. Vance, on Trump's running mate on the Republican ticket, has also expressed the same kinds of desires to have more oversight over mergers and acquisitions. So this is, you kind of see the politics melding here of, that both sides are proposing very similar policies.
All right, Laura, thanks so much for joining us. Bloomberg's Laura Davison reporting in Washington. By the way, if you take a look at WSL Election, which is a great function on the Bloomberg terminal that helps you round up both polling and the betting markets, it looks like Harris is ahead in terms of Real Clear Politics polling. That's an average of polls, as well as the predicted betting markets. Still ahead, you may not find the new Starbucks CEO working from Seattle. We'll take a look at some of the sweet, sweet perks awaiting Brian Niccol. Social Climbers is next. This is Bloomberg. Let's get a look at this rally, why don't we? We are up across the board in terms of the indexes. S&P 500 adding more than 1%. What a week it's turned out to be. This is the best 5-day rally that we've seen so far this year. In terms of the NASDAQ 100, we're up almost 2%, 1.75%. It is 2% if you look at the smaller cap stocks on the Russell 2000, for example. And we are seeing rates rise as well. So investors are selling off bonds, feel comfortable enough to let go of that debt. The 10-year yield is up to 3.92, and the 2-year yield is up to, I think, 4.08 right now. So big rate rises across the board. In terms of individual stocks we're watching, check out B. Riley. Those shares have been halted. On Monday, the firm announced a new round of write-downs, and then we heard about a widening U.S. investigation from the SEC about whether it gave investors an accurate picture of its financial health and investigating the relationship between the CEO and the head of the asset that was written down. And now you see the stock falling, I think today, another more than 20%. And you see the worst drawdown, Katie, in a decade.
We'll continue to keep an eye on that one. But it's time now for Social Climbers. The company's making waves this morning. And first up, Ulta Beauty showing off its shine after Warren Buffett's Berkshire Hathaway disclosed that it took a new stake in the cosmetics retailer. Of course, it's been anything but rosy for Ulta Beauty since about March, when it gave that disappointing outlook and said that higher supply chain costs and increased promotions hurt its margins. Next up, we have Coach parent Tapestry beating Wall Street expectations despite weak consumer confidence and inflation fears. The handbag maker also reiterating its commitment to buying Capri Holdings, parent company for brands including Jimmy Choo. The FTC, of course, sued to block this deal in April, a trial set next month. And finally, when newly appointed Starbucks CEO takes over next month, he won't be in Seattle. Brian Niccol instead will be working remotely from Newport Beach, California, where Chipotle, of course, is currently located. Niccol agreed to commute to Starbucks headquarters and travel as much as needed to do his job. White-collar Starbucks employees, on the other hand, are still required to be in the office at least 3 days a week, Matt.
All right. You can follow, by the way, all the latest company buzz on TrenGo, TREN-GO, on your Bloomberg terminal. Let's keep talking about this Starbucks issue. It has bet on Brian Niccol, and the pay package is pretty eye-popping. It's going to cost the coffee chain about $113 million to get Niccol in the office. That includes giving him, I think, $75 million in stock grants to make up for what he's lost leaving Chipotle. Plus, they're going to have to pay the outgoing CEO about $10 million, at least $10 million. So a pretty much expensive exercise, but it's been worth it in terms of adding like $20 billion in market cap, right? Let's talk with Bloomberg's Brian Chappatta, managing editor for Wealth, about this. So we're talking about some big numbers. If you break it down, they're still big, but not as big, right? Like just his pay package for this year, it's only like less than $30 million.
Only, yeah. Definitely. Definitely only. No, it's an interesting one. He's kind of a breed of the superstar CEO almost that we're seeing, where if you are successful in keeping a company on the rise, that you will get poached. To your point, a lot of the money that he's getting is a result of what he would have gotten at Chipotle. So Starbucks really had to sweeten the deal and basically comp him to just get him. And then in addition to that, signing bonus, equity,
$10 million
grants.
signing bonus,
Yeah.
$75 million equity grants, and like, what is it, $25 million pay package?
Yeah, it's a lot of money, but you know, if he's the guy that they want, Elliott maybe wants him, although they say there was no outside pressure, then that's the price you're going to have to pay.
Can we talk about the working remotely part of this? Because it feels like Matt is really incensed about this. And like I read, I mean, white-collar workers, I don't know, it seems to keep coming up.
I'm not incensed.
In our meeting, it was a real point of discussion. I mean, what do we know about that?
Well, I mean, I think it's part of the transition, right, that needs to happen in this current day and age. Like, you're not just going to start pack up and move. I mean,
Dude, for $113 million, I'm going to pack up and move tomorrow. Like yesterday. I'm out of
But what if
it.
you could do it from home? Because that also sounds
Exactly. Well,
crazy.
if you can demand, if you can say, listen, you're only giving me $113 million. I want a full setup in my office at home. You pay for that, and then I'll come into the office like once in a while.
I made Chipotle stock go up like 280% in 4 years. Maybe you have some leverage.
I mean, again, it speaks to just the fact that Brian Niccol was very clearly in demand, very clearly the guy. And so they said, okay, this is what you want. This is fine. We're going to make it happen.
It's going to be really interesting to see if they change the Starbucks work-from-home policy for the office workers.
Apparently, they ran it by Schultz, but they did not run it by Elliott, at least according to our reporting, right? Schultz still has a big say in what goes on at Starbucks.
I mean, Schultz is super interesting, right? Like, obviously from the Wealth team, he's a billionaire multiple times over. He's also been the CEO 3 separate times, so it feels like you can't quite distance Starbucks from Schultz. Starbucks is just a super interesting one, you know, from the Wealth perspective. Melody Hobson, the board chair, also is a part owner of the Denver Broncos with Rob Walton, right? And she's also married to George Lucas of Star Wars fame, right? So it's a really interesting company in terms of the billionaires and the money that's swirling around it.
It is. It is. Brian, thanks so much for joining us. Brian Chappatta there on Starbucks. This is Bloomberg.
Pricing has been going up. We're guiding in Q3 and Q4 for prices to go up.
As we're taking in new bookings, which we get to see each and every day, the willingness for our guests to pay more for those experiences.
Pricing will absolutely go up in both quarters, and it looks that way for 2025 certainly as well.
They're willing to pay it, and they're also willing to book much further ahead.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
And that was a string of top executives speaking on Bloomberg Television about the consumer and specifically about travel demand. Looking now to add his insight, we have Priceline CEO Brett Keller joining us now. Brett, it's great to have you with us because it feels like for the cruises, you're still seeing really robust demand there. We were talking about pricing power with some of the CEOs of some of the big cruise lines earlier in the day on Bloomberg TV today. And then you take a look at the airlines. It's a much different picture, of course, when it comes to the forecast for travel demand. From where you're sitting at Priceline, how does it look to you?
Yeah, well, I think what we're seeing is that consumers are certainly seeking out value, and cruise lines create and produce a lot of value for consumers. It's one of the cheapest ways to travel in terms of all-inclusive meals, entertainment, et cetera. And many times you can spend less than $100 per person per night. So it's great value there. We're seeing the same thing. We have shoppers coming into Priceline specifically focused on our value offers, whether that's our vacation packages, express deals, et cetera. When you look at the flight industry, listen, TSA numbers continue to show that there's growth year on year. In fact, we're tracking 5 or 6% up year on year for the last month. And so consumers are still flying. I think what happened in the airline space is they added a little too much capacity, and so they're removing that as they look forward over the next quarter. And that's going to put a little more pressure on pricing as their prices have been down for most of the year.
I mean, what's your opinion there that maybe the airlines were betting that this post-pandemic burst of travel that we saw was going to be sustained, whereas now it seems like maybe we're returning to more normal pre-pandemic levels?
Yeah, obviously travel's been very hot for the last year and a half. Consumers were really investing significantly in that part of their spend. And so we saw a lot of travel overseas, which is a very rich part of the travel experience for the airlines. And so I think what's happening is consumers are pumping the brakes just a little bit, but travel is still healthy. It continues to be one of the highest prioritized discretionary spend categories. And we're certainly seeing that, I think, across the industry. But there are some pockets, leisure travel in particular. Consumers are being a little more careful about how they're spending their dollar as they've kind of come through this peak of summer now in travel and are looking forward to Labor Day and beyond.
Last year, Brett, AI was the buzzword in markets, and it's also something we heard a lot from companies. How have you worked AI into your product?
Yeah, thank you for asking that. Listen, we were one of the innovators of AI over a year ago. We launched chatbot and have put that to work. And we're finding that really across the consumer booking process, this is becoming more and more natural for consumers to interact with. So they're using it not only to plan and think of itineraries ahead of booking their travel, but during the booking process itself, they're engaging in our chatbot, asking questions about the property that they want to stay at, the location, the activities nearby, and then post-purchase, they're using it to service their product. It's a much easier way to very quickly cancel a reservation, make changes to a reservation, or find out more information about a refund or other things that are important to the consumer. So we're finding it to be a very useful and innovative tool to help the consumer just smooth out that travel process all along the way.
How hard are consumers working to save money? I mean, when you say refund, it makes me think about sometimes it's not easy to get those. You've got to do the legwork. When I look at, for example, car rental prices, it always doubles once I add all the insurance and fees. And then if I really want to save money, I'll actually call my credit card and say, hey, am I insured for this rental car? Or figure out with my State Farm agent. Like, are customers doing the extra work to save the money?
Yes, consumers are absolutely, I think, taking the time to not only shop ahead of their trip, to look at the various different players in the space, who can deliver the best value and the lowest price. And two, to your point, when it comes to add-ons, whether that's insurance, activities, even dining, they are making very specific decisions to fit that within their budget. And so Priceline, for example, offers an insurance product with their rental car. And we've actually seen the insurance take rates go up, meaning more people are adding insurance to their car. I think that's just part of the post-pandemic experience. People are really trying to protect their purchases to ensure that if, for in fact, they have travel disruption or something happens on the trip, they're covered for that. Consumers are interested in that.
Are they clicking on the insurance, the airline insurance as well? Every time you buy a ticket, the airline says, hey, if you give me $20 more, you can cancel on the day of. Are more consumers using that?
Yeah, we have seen an increase in travel insurance associated with an airline ticket purchase, especially for the bigger transactions like a vacation package. People really do want to protect their investment, and insurance is a legitimate and a very good way to do that.
I want to talk to you about trends that we might be seeing when it comes to length of travel. There was a really interesting story on the terminal a couple days ago that had data from Embark Beyond, which found that the average trip length is down 14% year over year. It now averages 6.2 days rather than 7.8 days. Now, Embark Beyond, it serves primarily U.S. ultra-high net worth individuals. But are you seeing similar trends when it comes to Priceline's customers?
No, we service the value consumer, and in the data that we're looking at, we haven't seen a material difference in length of stay for our consumers. They continue to, book at a fairly normal rate in terms of how far out they're looking, and so we're not seeing a significant collapse, for example, in last-minute bookings. And consumers are, really taking the same types of trips. I think where we're seeing the focus now is on what type of trip am I going to take? And am I going to change that behavior based on what my budget's going to allow me to do? And so obviously last year and really earlier this year, we saw a lot of travel overseas, over to Europe, over to Asia. Now, as we approach Labor Day, we're seeing a lot more consumers interested in more nearby destinations. So things like Mexico, the Caribbean, the Bahamas. People still want to take that vacation. They want to get to beaches and warm destinations, but they're sticking a little bit closer than they were, say, 6 months ago.
And I mean, it's interesting to tie it back into, how we started this conversation. You think about how people are traveling. We've been talking about the trade down across industries really all year. When you think about sort of the shift from airlines, now cruises are hot really now. You see people traveling by car more. I mean, is that part of that overall trade down narrative?
Yeah, that's something we watch very closely because, it's a very rational thing to do, right? You would have stayed in a 5-star hotel, now you're going to stay in a 4. You would have stayed in a 3, and now you're shifting down to a 2. We haven't seen a material move in that trade down experience in the bookings and in the consumers that we're looking at here at Priceline. And again, I think people still want to travel, but they are looking for discounts. They're looking for deals to save. They want to do the same trip they did before, but they'd like to knock off a couple of dollars on that trip and bring the pricing down. And so, again, we're seeing a lot more interest in our value offers on our Priceline website.
All right, Brett, it's always a fascinating conversation with you, of course, as we monitor the consumer and the traveler. That, of course, is Priceline CEO Brett Keller. Let's get a check on these markets right now, about an hour into the U.S. trading day. We're going to do that with Bloomberg's Abigail Doolittle.
We have a pretty solid rally on our hands, Katie. We have the S&P 500 up more than 1%, up for a 6th day in a row. And it's extraordinary. Take a look at the VIX that had spiked to about a 65, 66 handle on the height of the yen carry trade unwind, at least that leg of it. There could potentially be more. It's now back below a 15 handle at a 14.8. Really pretty interesting. Taking a look at the dollar yen at a almost 150. The charts are very interesting here because it does still look like you could see that dollar yen slide to 130. If that happened, it would suggest that the yen carry trade unwind, that there's more to go. Right now, though, that is certainly not the case. And then another big mover here, the 2-year yield backing up 12 basis points as those claims came in better than expected, suggesting that the economy may in fact be okay. And on the other hand, suggesting that the Fed may not be able to cut as much, so yields moving in that direction. In fact, let's put this move into the perspective of recent moves to see just how big it is. So, of course, here is this large move and going all the way back to the beginning of June, matching the size of that move, which was closer to, let's call it 15 basis points or so. And then finally, some movers on the day, Matt. If we take a look at Tesla, it is up 7%. Not really clear what the news is there, but it's certainly driving some of these big indexes, as are Amazon and Nvidia. A nice rebound for some of these mega cap tech names. And then, of course, there is Walmart up 6.4%. Good quarter, good guide. And it seems as though higher income folks really going there, supporting that store, but they're not seeing any fraying in the incomes of their customers. So net, Walmart putting out some good color, interesting color, but suggesting that the economy is okay right now.
All right, Abigail, thanks very much. Abigail Doolittle, look at some stocks for us an hour into the trade. Coming up, car connoisseurs are racing to Pebble Beach for one of the most important weeks in the auto industry. We speak with Mecum Auctions CEO Dave Majors next. This is Bloomberg. Let's get to the trading diary. This is what you need to be watching this afternoon and tomorrow. We'll hear from Philadelphia Fed head Patrick Harker this afternoon, so you want to pay attention to that on your terminal. You can type FedGo. Tomorrow, U.S. housing starts are released. Plus, we're going to get University of Michigan consumer sentiment data, and we're going to hear from Chicago Fed President Austin Goolsbee in the afternoon. He is focused on the labor picture. I also saw a great story on the Bloomberg terminal today pointing out that over the last 12 months, total debt servicing costs have been $860 billion. However, if you add in the amount of money that the Fed has to remit in interest expenses, it gets closer to $1 trillion over the last 12 months. This is how much the Fed has had to pay out in terms of interest, and the total debt servicing costs for the U.S., Katie, now exceed what we spend on the military, what we spend on Social Security. In fact, nothing else exceeds that. We spend 20% of our tax revenue just paying interest on the debt that we owe.
Yeah, $861 billion. That is what the Treasury spent in net interest on the national debt over 12 months through July. For context, that is almost double what it was 2 years ago. Of course, this is the consequence of that rate hiking campaign that the Fed has been on. But whenever I see numbers like this, of course, they're large, they're scary, we're spending a lot of money. But it kind of reminds me of what Steve Eisman was telling us about the deficit. How do you trade on this? I mean, what does it matter for investors truly in the here and now?
Well, it doesn't matter until it does matter. And when it does, all of a sudden,
just like valuation,
all of a sudden, the way you want to trade on it is to have sold everything before.
Right.
You know, just buy water, canned food, and guns.
I want you to give me a heads up right before that moment happens.
Obviously, we don't see it kicking off now. And when I talk to investors about this, they all say, look, treasuries are trading at 4%, right? The dollar is strong. No one cares.
Fine.
But at some point, someone will care. It's still, you notice when you look at the Democratic platform, what's being built of it, when you look at Donald Trump, when you look at the Republicans, no one cares about reining in spending.
And I don't know if it's going to come up necessarily when we get to the debate stage finally, whether we're going to get that level of substance, but we'll have to see. In any case, in the here and now, we're looking at a rally, a green day on the screen. If you take a look at the S&P 500, up over 1%. Even more so, if you take a look at big tech, what a move we're seeing in the NASDAQ 100, up about 2% right now. Of course, we got retail sales coming in better than expected. Of course, the consumer is still resilient. They're still spending money. At the same time, of course, you have inflation coming down. We got that softer than expected PPI. You add it all together, and really, it kind of looks like a soft landing here, and you're definitely seeing that reflected in the markets, Matt.
All right, yeah. The rally over the past 5 days really has been amazing. I mean, we've been up, 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 and completely erased all of the losses that we had on that manic Monday.
No one's thinking about interest expenses. It's crazy.
It's true. No one's thinking about interest expenses. Nobody's terribly worried about the slowdown that we were worried about. The carry trade hasn't freaked anybody out. We just continue to run, and investors are willing to sell off treasuries as well.
There you go. All right.
We are going to go out to the West Coast, live in Pebble Beach for one of the most important weeks in the auto industry. We'll speak with Mecum Auctions CEO Dave Majors next. This is Bloomberg.
Well, plenty of economic data coming out this morning, of course, headlined by that blowout retail sales number. Here to break down everything we've learned about the economy this week, I'm pleased to say we have Mike McKee, Bloomberg's Chief International Economics and Policy Correspondent. And I'll ask you the question I've been throwing to our markets guests. You think about what we got in PPI, CPI, and now retail sales. I mean, is this nirvana? Is this the soft landing?
I tweeted that earlier today. I think that there was a senator back in the Vietnam War days whose idea for ending the war was declare victory and go home, just leave. And I'm saying they should declare soft landing and go home, cut rates and say we did it, because it's about as good as you're going to get right now. The Fed wanted to slow the economy, and retail sales shows a slowdown, but it doesn't show any kind of hard landing or crash. And obviously, inflation continues to come down.
And of course, it depends on which quintile you're in, right? Because in some circles, spending continues unabated.
Well, we've seen the money people got from the pandemic has pretty much evaporated, which means that people at the lower income scales are spending on their paychecks again, and they tend to spend most of it. And so you see the impact, more people shopping at grocery stores and at lower end stores. Walmart today was a good example of what's going on because they reported that they're seeing more people from upper incomes come in as well as people trade down to try to take advantage of lower prices. We've seen inflation rates fall, but inflation levels are still high. And Walmart hasn't seen any diminution of its regular customers. So they're still seeing people out there spending on pretty much everything. And now they're bringing in more people.
Including pool noodles.
Yes, so many pool noodles.
How many?
In fact, if you spread out the pool noodles sold by Walmart in the last quarter, it would cover 30,000 football fields. So I just worked it out. I'm not sure if I'm right, but that's about 1,700 miles. Anyway, Mike, thanks so much for joining us. Mike McKee, their Chief Economics and Policy Correspondent. Monterey Car Week kicks off today in Carmel, California, with rallies, races, new car debuts, and the most important classic car concourse in the world at Pebble Beach. Plus, there are always record-setting sales. The average price of cars auctioned off at Monterey is now about $1 million a piece. And the average age of those cars crossing the block keeps getting younger every year. Mecum Auctions CEO Dave Majors joins us now from Pebble Beach to preview his 3-day sale. Dave, thanks so much for joining us. I'm so jealous that you're out there. I know it's your 15th year. Talk to us about, I think it's very interesting that, I don't know the exact years, but the average age of a car crossing the block in Monterey was like early 60s. 10 years ago, and now we're creeping into the 70s. So newer vehicles are becoming the big hits, right?
Yeah, and I think, even if you look at the collections that we've brought here to Monterey, what we're starting to see is a lot of interest in the later model exotics, the Porsches, the Ferraris, Mercedes. Are getting a lot of attention in Monterey, as well as, even pre-war. We've got a Delage here. We have a Delahaye, we have a Packard that's here. So you have pre-war cars, and then of course we have the mid-50s and 60s. We've got some 60s and 70s American muscle cars, but then there are a lot of exotics too. I think that I counted the number of Ferraris here at our auction. There are 26 of them. The earliest is from 1952, and the latest is from 2021. So pretty much everything in between.
Are all of these prices, Dave, continuing to rise? I mean, obviously we have high net worth investors watching Bloomberg television. And during the pandemic, prices for any vehicle were up. But did any of them turn over, or did they just go up, up, up?
Well, actually, coming out of the pandemic, starting in 2021, we saw pretty much a meteoric rise in prices of vehicles across the board. And as you know, even used car prices escalated significantly during that time period. But collector cars, it didn't matter if it was pre-war or late model, they all were going up 25, 30% a year. The sell-through percentages were going up. We're a reserve auction. When we would go to auction, we were selling 90% of the cars that would cross the block, which is about 20% higher than typical. What we've seen starting in 2024 is not a retreat necessarily, but we have seen prices flatten out. And I would say we're probably going to see that in 2024, and I expect that to continue on into at least the first part of 2025. And of course, what we've seen in the collector car auction business is every presidential election year, we see a little bit of market stabilization. The market goes cold for just a bit as everybody stands by to see what's going to happen in the White House.
Which car do you expect to garner the highest price that you're selling? And what makes, a record setter worth that much?
Well, we have a 1969 Ford GT40 Mark II that will cross the block on Saturday. The expectation is somewhere north of $8 million for that car. And that's a car that everybody's familiar with now because of the Ford versus Ferrari movie. It is one of the Ford versus Ferrari movie cars, a later version of that car. But actually the Mark II was a car that was built prior to the Mark III and Mark IV that you saw in the Ford versus Ferrari movies. But it was a smaller engine block. And the Ford decided that they were going to put larger engine blocks in their vehicles, consequently won Le Mans, 66, 67, 68. And then it was decided that engines and power plants were too big in cars that were racing in road races, and the rules changed, and the Mark II came back in with its 289 and had success in racing careers after starting with 1969. So it is the heritage of the Ford GT40, and of course we know 2005, 2006 Ford brought those cars back, and then they brought them back again in 2017. So very recognizable car and has a great provenance.
I like Gen 2 myself. Dave, thanks so much for joining us. Dave Majors of Mecum Auctions coming to us from Pebble Beach. For all things cars, by the way, you can and should listen to my podcast, Hot Pursuit with Hannah Elliott. You can check it out on the Bloomberg Terminal or wherever you get your podcasts.
No, I've listened to it, actually.
Have you?
Yeah, I listened to your interview with Jim Farley. It was pretty good.
CEO Ford, that was a good one.
Yeah, I would recommend it. Anyway, you take a look at markets right now. We're still rallying. The S&P 500 up quite mightily on the day, up over 3% for the week. Of course, before we get to Friday, we'll continue to follow all of that and more. This is Bloomberg.